In the fast-paced world of business, finding a clear path to profitability can be a challenge. Welcome to 0 to 100 with your host, Jared Guy Randolph, seasoned business and finance expert. Tune in for actionable insights and strategies to accelerate your business success.
Hello, Accelerators. Today on 0 to 100, I'm excited to introduce our guest, Ishali Mulchandani. She is the founder of IDM Chartered Professional Accountants. She is a business coach and tax strategist. She's actually qualified as a CPA in 3 countries, the US, Canada, and the UK. And she is also the author of Achieving Business Prosperity. We're going to talk about some really interesting topics that I want you to key into. And one that we really dive deep into is how an abundant mindset can lead to success in your business finances. We'll also talk about the power of compounding, leveraging your losses, and get deep into strategies around tax deferral. For those of you who do not know me, my name is Jared Guy Randolph. I am the founder of BoxFi. We are the nation's leading payment consultant, providing business growth solutions through payment processing. And I'm very excited to share the network that I've built over my 25-year entrepreneurial journey to help you grow your business and become more profitable. Ladies and gentlemen, let's accelerate together. Ishali, thank you for joining us on 0 to 100.
Thank you for having me. It's a pleasure to be here.
Very excited to have our discussion today about thinking outside of the box. And actually, one of the first quotes that you said to me is, "There is no box." And that's unique to hear from a CPA who is very seasoned, is that there is no box. Will you talk to us a little bit more and tell our audience of entrepreneurs and business owners what means and what that should mean to them?
Sure. So I find that a lot of the times we people have a lot of limiting beliefs, and business owners are running their business. They're great at what they do, but they're able to just listen to what their accountant is telling them or what they read online. And see, accounting and tax is all about rules. I respect rules, but I also value the creativity. Because most accountants are kind of trained to say you have to do this like this, you have to do this. So it's you wear blinkers and you just follow the rules and you report everything. But there are so many things that get missed. And that is why I say, for me, there is no box, because possibilities are endless. Why do you have to stop at one source of income? You can have many sources of income. Why do you have to feel as a business owner, if you make a lot of money, you got to pay a lot of tax? There are such cool ways that you can leverage different losses against your earned income, and you can get some deductions. There are so many ways that there are some expenses that you don't realize you're leaving on the table that are business deductible expenses that you can write off. I'm not saying that we get aggressive and we just go on and claim things that are not legitimate. This is all staying within the lines, but using creativity. And when it's creativity, there is no box, which is why I said there is no box, because you can have a happy dance between following the rules and being able to get the most out of your business deductions, the most out of all the credits you're entitled to, the most out of the efficiencies you can have internally. So there's the number one rule we learned when I studied tax. There's a difference between tax evasion and tax deferral. Tax evasion is illegal. I do not recommend that. I'm not saying that we shouldn't pay them. If we have mechanisms that can defer it, because $1 is better in your pocket today than it is tomorrow. So if you defer it, you can take that money and repurpose it and build more wealth. And that is what I'm more in favor of. When I say there is no box, there's limitless possibilities when you have more cash flow in your hand to do that.
You might be one of the first CPAs I've heard say tax deferral. I've heard CPAs talk about tax avoidance, but never deferral. What do you mean by tax deferral?
Okay, so let me help you understand. Mainly with an example of, for example, the cost segregation study. As a real estate person, you'll understand that when you're doing cost segregation, you're segregating the different asset classes into 5-year, 10-year, 15-year, thereby allowing to write it all off in the same year, a big chunk of it. Now, when you write it all off in the same year, again, it doesn't translate to more money unless you meet those conditions, right? You're converting passive loss into active and offsetting it against your active income. thereby getting ability to write off tax and get a refund or pay lower tax. Now, when you reduce this tax burden today, it will come back to you later on when you sell your property. And that's why it's a tax deferral mechanism. Okay. So you're not completely avoiding paying that tax. So when we say tax avoidance, there is one thing, there are two things certain: death and taxes. They are going to be there. But it's just leveraging this saving today. Like if you got an extra $222,000 today, I don't know where I came up with that number, but if you got an extra six-figure number today, which could be as much as we've saved our clients and more, actually, in some cases, using multiple different strategies, they can take this money and buy more real estate or buy more stocks and buy more. And you see the power of compounding when that money is growing. Later on, when you have to pay that tax, you have more money in your pocket, so you can absorb that cost later on. Plus, your dollar is worth less. Plus, who knows what rules can change in your favor. I'm not going to go political on this, but I know that there are some talks in the works of reducing tax in some sort. So if the rate drops in your favor in future, it's a total win-win.
Right.
Hence, tax deferral makes sense.
So
Right?
tax deferral for any business owner, anyone who has substantial income, can be compounded because you're able to reinvest that money in other assets. For example, real estate, where you have even further tax deferral mechanisms so you can continue to grow your money at a higher rate. And there was something that you said, which I thought was really great, was the multiple income streams. Our audience of business owners and entrepreneurs love to hear that. We also know that there's a lot of smoke and mirrors when it comes to that, because people who are the wealthiest, who have 8 businesses, they made their money in one business first, and then they invested in other things to diversify. Talk to me about what you mean with multiple income streams and how that relates to taxes.
So multiple income streams could be many different things. I have a lot of clients who are medical professionals, and they're artists at heart. They love their medical profession. So they make a lot of money, but they don't know where to park their money to make the money work for them. And even if they do, they're not very, usually are not clear on how they can do it in a more optimized manner. So a lot of them love real estate. So they do buy real estate. So they've got W-2 income, they've got 1099 income, they've got real estate, but they also like to be like partners in a fund. So it's more passive. Their involvement is next to nothing. They just put the money in funds, and those funds could be in real estate projects, or commercial, or multifamily residence, or whatever that is. And that's the extent to which they will go because they're really busy with their job. But then again, I have business owners who have many different kinds of businesses. And sometimes those businesses are not related. Like I have a client who does, windows, and then they do blinds, and then they do real estate, and then now they're doing cars. So it's exciting because what happens is when your business is at a stage where it's mature, like it's got a lot of cash flow, then it's birthing another baby that takes that cash flow, because any business that you birth initially takes a lot of your money. So what then happens, it gives the business owner an opportunity to take those losses and offset, reducing the tax burden. When that business grows again, you do that again and again and again. So it's literally one is feeding the other. Sometimes that's the case. Sometimes they have other investors. Either way, how we structure the businesses, how you leverage active versus passive becomes a game on how you can eventually end up saving tax dollars. Because there's no joy if your one is active, one is passive, you can't offset.
So how do you properly leverage active versus passive investments?
These are done with detailed conversation during the year with the client, especially when they're trying to get another business set up. We understand the end goal, the outcome of what the client wants, and say, okay, so if you are looking to do this business, what is your intention for it? And then we obviously see the nature of the activity as well. And then we advise the client accordingly, set it up in this manner so we can do this, that, and the other with it. So these are planning things that we do. There's no one size fits all. Alternatively, if somebody is expecting a huge amount of passive loss, then we like to offset the passive income against that to neutralize it and decrease the burden. And it's all about the timing. It's all about the timing. So let's say somebody is exiting, like we've got a client who wanted to sell a lot of real estate. And we told them that, do you want to defer the tax? Do you use the 1031 exchange? And we helped them use the 1031 exchange. then the tax got deferred. But before we did that, we asked them, when are you looking to sell the new properties? There's no point telling them that. The timing of cost seg or 1031 has to be, we have to keep in mind what the client's trajectory is.
Mm.
We need to understand that. So it was so interesting because one of the clients took advantage of all the depreciation. And one thing to remember is when the depreciation recapture happens, which means when you sell a property, there is a capital gain component, which is charged at anywhere between 5 to 20% depending on your income. So the capital gain is very simple. It's what you sold it for less what you bought it for, plus any costs that were incurred in the property to make it better, like improvisations, right? So that will attract capital gain tax. But any depreciation that you got deductions for before, when they are recaptured, that portion will attract your marginal tax rate of tax. So there's a differential. So just to be aware of those liabilities is very important because that throws off investors a lot of the time. They think it's just cap gain on the whole thing. It's not.
And that's actually something very important. So I've done in real estate projects before, the cost segregation. And when you sell that, because typically, unless you're holding it for a very long period of time, there
Yeah.
will be depreciation recapture from the depreciation that you took up front. So unfortunately, you can't take that depreciation up front and then go sell it the next year and not have to pay the government. So those are things to think of when you're calculating your numbers as well.
Exactly. Yes. If they say we're going to sell it again next year, then we need to keep in mind that this is going to come back next year. If you're expecting a lower income next year, then that would still be a good strategy because you're just spreading it over. So what you're doing essentially is if you're spreading your income over multiple years, just so that you're staying below the highest tax bracket, that could be a good strategy to use.
So even if you do buy a property, do cost segregation, hold it for 2 years, go to sell it, and your intention is to reinvest that, you can still defer those taxes. So that's what I was saying. As long as
Yeah.
you're buying another property in place, you still
Yeah.
deferring those taxes. Because I want
Yeah.
to make sure that I'm clear. When you have people, especially who aren't as versed in real estate investment, is that you buy a property, you do cost segregation, you sell it 2 years later or even a year later, no matter what, you will have that depreciation recapture. But what if you have a big loss that year? Will you still have the depreciation recapture?
If you have a big loss, so what happens is that the loss is utilized. It's a passive loss in its nature. And, it depends on what is your activity? Is it passive? Is it active? So when you talk about losses, if your real estate portfolio, your real estate activity is active, then it will offset against that active loss. If it's passive, if your loss is active and so is the real estate activity, it will offset. If the loss is passive and so is it will offset. That's how it works usually.
Yeah. A lot of our listeners I know, because many of the listeners I know, and we've worked with them from a business standpoint, they own their own real estate, whether it is a landscaping company, nursery, or a doctor's office. They own their own real estate. So these are things that are incredibly important.
Yeah.
What I'd love to actually talk about is something you mentioned earlier, and that is expenses. As a business owner, how should we be looking at our expenses to make sure we're maximizing our deductions?
So first of all, very clear and good record keeping is very important. And secondly, keeping an eye on it because a lot of the times business owners will spend out of pocket and they don't even realize it. So helping yourself to understand that anything, absolutely anything that is to do with business, let the business pay for it. If the business doesn't have its own funds for whatever reason, you can put money in the business and that money you can take out anytime tax free. Alternatively, if you don't do that and you're spending on behalf of the business, make sure that you have a proper paper trail to say, here are the expenses I made, and business, you owe me this money. If you are able to clear that separate distinction, it will only serve you greater in the long run. Because a lot of business owners make a mistake, think, oh, I didn't make much money. It's okay. I don't have to record it. Please do not think like that because if there is a loss, it allows you to offset it. If not this year, then later on. It sits there until it's utilized, especially in the initial stages. A lot of people have this myth when they're birthing a new business. They think, oh, I didn't make much money, so I can't do deductions. You can absolutely do them. We all know that when a business is starting out, it upfronts a lot of its money. whether it's R&D or if it's, operational cost or marketing cost or training costs, whatever those costs are, they're upfronted at first by the owner and they should be deducted. These are the common ones I see that being missed all the time.
Mm.
The second one is the use of home as office. There are so many different things. There's something called an Augusta rule that a lot of companies don't take advantage of, because you do use your home, whether for the most part, whether you realize it or not. Some intentionally use it, but some don't realize when they're using it. So it's important to be able to offset those expenses as well. Plus, any when you're traveling, you would be spending some of your own money. Make sure you keep all the receipts and deduct all those costs, whether you're going for a conference, when you're going for networking, when you're, sometimes family members help you, but you don't put them on payroll. You should. And, this way, you're also equalizing your money income for the household, reducing your overall tax burden as well.
Mm. I have a question specifically about the Augusta rule. So we entertain a lot. I know it's 14 days out of the year. Your company can, and you can talk the audience through this, your company can basically lease the property from you. So how do you make sure you're documenting it properly? Because I'll have clients over, I'll have business partners over. And even though we're having a nice dinner and connecting personally, there is a lot of professional conversation that happens. Is that something that would count towards the Augusta rule, and I could use that as a write-off or not?
So if you're having business conversation, of course you absolutely can. And the key is the documentation. So do your homework, have 3 comparatives to see how much your place is worth, if you're renting that space out to someone else. And if you have those documentation, so you have your per day rate anyways, and then you are, let's say you're having these meetings. So it has to be documented. I had a meeting on this day, this is what happened, and it's saved. Those documentation are saved. So if ever IRS asks you what's, like, do you have backup for this? You have it. And that then you can easily take the maths at the end. You can do this adjustment at the end of the year. You don't have to do as and when it happens. If you do it as and when it happens, it's even better because you're not forgetting. But 14 days is the max.
Actually, that's incredible because I had hosted a handful of dinners that were all business related. And a lot of times they were connecting one business relationship I had with another business relationship, and also some offsites that I had at my house where we would do a whiteboard session for an afternoon. So those are really great tips. And I do believe a lot of business owners actually overlook that and don't realize that that is an option. It's not just having a big party in your mansion in the Hamptons. It's literally have a meeting in your house. Awesome. So we are in the thick of tax season right now, which thank you for taking time in the middle of tax season to have this conversation with us.
No problem.
How best can an owner prepare for tax season?
So I'm a big believer of not just preparing in February, March, or April for tax season. I would encourage every business owner to have a proactive approach than a reactive approach. Preparing for it now is a very reactive approach, in my opinion. If you got a business, you would have had to have a conversation with your CPA way before. Say, hey, this is how much money every quarter, ideally. This is what I've done. This is how much money we're likely to make. How much estimated tax do I owe? Is there any way I can save this money? And if so, let's implement those things so that later on, everything is all easy and we know. Because what you don't want is to find yourself in a position that when your extensions are filed or your returns are filed, that you have a big tax bill, because then you're incurring interest. You don't want to tip the IRS. You pay enough tax. So every dollar that you can save, this is one of the key ways I see a lot of leaks in our clients' funds when they have to pay installment interest or interest for late payment. So being prepared is key because it's there. Guys, it's not going away anywhere. I have a client who is so averse to tax. Whenever I talk to her, she says, "Oh, you're going to say the T word again." And I tell her, it's here. It's here to stay. So you may as well be prepared, understand what it is, and make contingencies to pay it. Because if you don't, like, I literally one day added up all her tax and interest and penalties, and I showed her that number, and she looked at me and she says, "What is this?" I said, this is how much you have paid over the last 2 years for late filing. She could not believe it. And I said, you could have taken your family on vacation with this money. So
Mm.
this is one of my biggest pet peeves is when, you want to pay them on time, but you don't want to necessarily pay and hurt your cash flow, which is why I said have those conversations with your tax professional, because right now I'm helping a client and they paid an extra $200,000. They didn't need to, because if they'd had a handle on their optics, they would have known that their one business made money, but the other one did not. And they did not have to pay that much money. And they were struggling with cash flow all year and could not make hiring decisions that hurt their business growth. So you see how it kind of compounds that effect?
It's so important. And it's something that I've learned to embrace, I'd say over the last 5 years, where one of my mentors said, well, you're paying taxes because you're earning money. It's like saying, oh God, it's another year. I'm getting older. There is another option. If you're not getting older, you're what? So if you're not paying taxes, you're what? You're not making money, or you're making so much money you have every deduction under the sun.
I heard somebody say every day above ground is a good day. So yeah,
Taxes and all.
taxes and all, because they're running the country, they need their taxes. But I'm just thinking, let's be smart and be proactive and pay only what you need to, not more than you need to.
So are there deductions that a lot of business owners and entrepreneurs are missing in general?
It varies. Some business owners are very savvy and already know that, but there are a lot of deductions that I see people missing. Like a lot of business owners don't know, they buy commercial property, they don't know about the cost seg rules, they don't take advantage of it. It's surprising how many business owners don't do it because they just don't know, and their CPAs don't know, they're not aware of it. A lot of them miss their research and development claims. There are some credits that people miss. It's a variety of different things. The common one is, like I said, planning. If your family member is helping you, just to be able to be planning, give them salary, using your home as office, travel, even your car. So I see two ends of the spectrum. I see people get really aggressive and claim the entire car expenses, and I see people claim none of it. And very rarely do I see a happy medium. The happy medium is when the client is very informed. The business owner is informed. Okay, this is the car. I use it for business and I need to keep a log.
Hmm.
And then you've got to keep a log and claim it all, because if you're using a vehicle for business, you should be able to get compensated for it. A lot of clients don't do that.
So
The owners don't do that. They don't get compensated from their business. If you just learn to treat yourself and the business as two separate, you are you and your business is your baby. You can have as many babies as you want, but you keep that separation, that you'll be disciplined about the money part.
mm, can we get a bit more granular about paying family members? Because I realize I have my partner help me with social media at times. Let's say your kid's helping you with social media. How do you structure that and they're doing it on a weekly basis? They're spending 5 hours helping you with social media. How do you calculate?
You absolutely have to pay them. You have to have an employment contract or some sort of paperwork saying you're doing this services for this company. So it's all documented. Put them on payroll if you can. I would strongly advise that, because then there's paper trail that the money is leaving your business and going into their account. And, whatever needs to be given to IRS is being done on a regular basis. At the end of the period, they've got a W-2. There is no argument about that. It's done all above board. Because if like, for example, it's 5 hours, what is each hour worth?
Mm.
Right? You can do that.
And it should be a W-2, not a 1099.
It can be a 1099 as well if if you're giving obviously over $600 in the year, which you are, you do a 1099. What might be useful is if they're doing other gigs for other people, that would be fine. But for the most part, um, you know, tax authorities like to see, is this exclusively for you? Then it's more like an employee. If this person is doing it for other people, also then a 1099 would be just fine.
Mm.
If you just started out and you're testing it, it's a contract, then a 1099 is fine. But it's a regular thing,
Mm.
then it could be argued that it looks, smells, and behaves like an employee should be an employee.
Gotcha. Talk to me a bit about entrepreneurs, business owners, and some of us. I suffered this at a time earlier on in my business, did not have any financial acumen whatsoever. How do you, as a business owner, and I've also seen it with some of the merchants that we work with on the payment side, they just don't know anything about finance. They're just really good technicians or salespersons at what they do, and they do a lot of revenue. But how do you create the right mindset around managing your money and releasing fear, shame, frustration, and anger? All these things pop up the deeper you get with people when you talk about money and their business owners. How do you create the right mindset?
So that's such a very good question, Jared. Thank you for asking that. Finances is so personal. It's like health. It's very individual, and a lot of business owners do have shame and guilt when they don't have the act together. They put that pressure on themselves, thinking that they have to. And I have a lot of compassion in that situation where I feel like you are doing so well in your business. That's what you're good at. This is what we are here for. We're here to help to guide you. But they're actually afraid of the tax authorities. They're afraid of looking at numbers because in their mind, they feel that's bad news. So I kind of play with them. I say, okay, I had this one client who came over, she's fractional CFO service offering. So when we have clients with fractional CFO, we go through their numbers, their projections, their budgets. And numbers excite me, and I realize they do not excite everyone. So I literally play with it. I said to her, I said, repeat after me. I love numbers, numbers love me. And she just looked at me like I was crazy. I said, just for fun, just repeat after me. I love numbers, numbers love me. And she started to say that. And we went and we giggled about it like little girls. And then I said, okay, now I'm going to show you some numbers and we're going to love them. And then she completely enjoyed that meeting. She lost her resistance because it was playful. And we actually played with numbers and said, look, what if you did this? Then you'll have this. What if you it kind of gamified the situation. It lightened the burden and it really helped her go to that next level because she was going to buy another location. And I was telling her, this is how you can make that possible. So taking that monotony away from numbers and including fun in it can remove the resistance. The other thing like the client who I said who doesn't like filing the taxes, and she joked, like we joke about this. I said, yes, I'm going to mention the T word again. I kind of play with them. And then I kind of get into their minds to think what will really work to make this more effective. Like that's why I showed her the tax interest and penalties that she was paying. And that really worked because then she wasn't late. So everybody's different. And I really am a believer of not giving them technical jargon because people don't understand. It's like doctors when they say fancy words to us, which could be a simple thing like you have a stomachache, they'll say a big long word for it. It's exactly the same in the accounting world. I want to meet the client where they are at so that they lose the fear and the frustration and the shame. And we can be on a level playing field where we can really understand, here are the facts. Let's make decisions based on these facts. It's just, there is an activity. It resulted into these numbers. Do you like these numbers? If you don't, let's twist and turn the activity a little bit by 2 millimeter shifts to give you the outcome you want. And then when you have the outcome you want, let's work on how to save you some taxes.
Oh.
It's that simple.
Well, I love numbers and numbers love me. And not only do I love numbers and numbers love me, I love money and money loves me.
That's another one. I love cash. Cash loves me.
Cash loves me.
Yes.
Speaking of loving cash, and it's funny because Bob Proctor says where your mindset goes, energy flows.
Yeah. Where focus goes, energy flows.
There
Yeah.
we go. And I have been, for the first time, I'd say over the last year and a half, looking at my numbers on a daily basis. And I've gone through the fear and the shame and the frustration and the stress. Even when I have money in the bank, I'm like, oh God, it's not enough, or I've got to pay all these bills. And then we have to close these deals, XYZ, whatever it is. There's been a comfort now in being friendly with my money and giving it attention and looking at it on a daily basis.
Yeah.
How would you suggest our audience look at making sure they're managing their cash and managing it appropriately?
Yeah. So first and foremost, this fear is very constricting, and money is energy and it flows. My first suggestion is more spiritual in nature, where we need to shift the focus to more abundance, to understand that it is coming. There's plenty out there. And when we approach it with that mindset, with that feeling, then I feel we have a better outcome. because we are not approaching everything with the sense of fear and constriction and in that mindset that oh, this may not come, and then we're not giving out that energy that's serving us. You see what I'm saying? Like, so to start with that first of all, and then just look at everything and see. I truly believe that a cash flow projection is very necessary for every business owner. Look at the past trends, see what you did, see how things went. What is your growth, like your growth trajectory in terms of percentage, your expenses, and then project your next 12 months. And then keep a close eye on it. Did it meet your projection? If not, what else do you have to do to make sure it meets and catches up in the following month to get the results you want? If you're not, it's like if you go to the gym once, you're not going to get the result you want at the end of the year. If you go consistently, you will.
Correct.
It's consistent work that is going to give you the outcome, not worrying, not stressing, not constricting. Just be open, do the work consistently. You'll get the outcome that you're looking for. That's what I believe in.
Wow. The abundance mindset when it comes to being a business owner truly has been a game changer. There's days where I'm not feeling abundant, but I have to push through it and realize that staying focused on what goals we set financially, what the money looks like, making sure that I'm working closely with my team and communicating. Those are the things that actually move the needle for you to keep pushing your business forward and for that money to flow to you, which is why we do what we do.
Absolutely. And honestly, Jared, it is very easy to get in that state because business is like, if you look at, those, what do you call this, ECG monitors, that the heart rate goes up and down. So this is our business. It goes up and down. So when it goes down, we need to know it will go up. We're not going to flatline. We don't want to, it doesn't go all the way because you breathe in, you breathe out. Everything is a balance. So it goes up, it goes down, but overall, even if you look at any chart, it goes up and down, but eventually moves up like this, right? So same as your business. So in those down moments, just to know that it is going to get better, and you just have to take some deep breaths. And it's easier said than done. Is what I'm saying. I have been through that pain myself, where things did not go as planned, and I had to say to myself, it's okay, because we're responsible for our own state. We're responsible for our own energy. The entire business depends on us. Our teams depend on us. So guarding our mind and our state is so important. And when we turn that energy around, then everything starts to roll better.
And I've experienced this in such a big way in my life where I'll get into these funks and I'll just think negative. And when you're thinking negative, you're not taking that phone call. You're like, oh, I want to talk to this person right now. But it could be the individual who's going to be your next opportunity to close a business. You're just like, oh, I don't want to go to dinner and drinks with this person tonight. But that's where you're going to meet your next client or your next investor. When you shut your mind off from, oh, I'm so stressed, I'm never going to be able to raise this capital for a deal or to expand my company, and you're not listening to what the people around you are saying. And I'll give you an example. One of my business partners for a year asked me, Jared, is there anything we can do to help you get this project over the line? For a year. And one day I finally said, you've asked me this several times. You want a 50-50 partner with me, put up the capital and co-sign with me to get this loan over the line so we can build this project? Came back to me 24 hours later and went, yeah, let's do it. A year. Wow. I just wasn't listening when he literally asked me a dozen times. And I finally was like, yeah, why not? Because you don't have anything to lose. So listen to when people are talking.
Yeah.
And when you're in that negative space, you don't necessarily hear that opportunity for yourself and for your business, which could take you to the next level. So I love that you went down that more spiritual energy journey, because those are the moments where you move the needle in your business.
Yes, 100%. I mean, like I said earlier, when we are in that space, we're constricted. And when it's like you're tying a knot, things are not going to flow. You need to open up, and you can only listen and you can only receive when you're open.
Yes.
Right? When even ourselves, when we have all that chatter, and our inner guidance will also tell us, your gut instinct will tell you. Because when you're making deals, there are millions of dollars at stake. You need to really listen to your inner self as well. Yes, there are facts. Yes, there are numbers. You have to pay attention to those, being aware of your downside, but also listen to your inner guidance. It's always telling you what to do. we get so wrapped up with the chatter, the external chatter, that we don't listen to our inner self often enough. So these are the little things that are most soft in the approach to the business side, but they're also very important because they are game changers. Like if in your situation, Jared, if you were open and you were not focusing on the things that were not working well, because we often do that, our human brain is designed to look for problems. So when it sees problem, it just focuses on that. It is mindful work to shift your focus and not focus on that and focus on what is working well. Because when you do that, when you focus from fear to love, when you shift your focus from negative to positive, great things happen. And that is mindful work, and that is our responsibility as business owners to do that.
There was a moment where I'd been very negative about my business, my payments business, and the growth, and we weren't hitting our numbers. And I went and had lunch with a friend, and I was talking about what we were going through and just venting. And at that moment, he said to me, he says, "You're not asking the right questions. You're not looking at this the right way. It is, where is the opportunity in this place of struggle?" And the place of struggle was the opportunity for me to say, what's wrong with my systems that I'm not achieving what I want to achieve? Why is my clientele base not growing? Why are we not closing the number of deals we were closing before? And then internally, we had a really in-depth conversation with that and realized that there was miscommunication going on. So we were still just focused on the numbers that were on the paper and our cash flow projections, that we were missing that internally two divisions of the team weren't communicating. So they were upset with each other because they weren't getting the information that they needed. Me as the leader and taking extreme ownership of that realized that I wasn't facilitating more clear communication between them. And then when we fixed that, we 3x'd what we were expecting for our returns because our clients were getting what they needed.
Wow.
Because our team was able to provide that. And as business owners, and we typically don't have this type of conversation, which I'm, again, really enjoying, as business owners, we really have to step back and go, am I the cog in the wheel? Am I providing a platform so my team can actually grow this business successfully?
You are so right, Jared. Most of the times, the chokehold is the owner. And like you rightly said, I appreciate that you just said that this person who told you you're not asking the right question is spot on. Sometimes when everything else is there, it looks right, but something's not making sense. It's usually something few layers deeper. And only by asking the right questions from yourself and others around that are affected will you get to those answers. If you can't be doing the same thing and expect a different result, you've got to change how you're doing things to get that different result. So in this case, you were able to dig deep and figure out that it was a communication issue between two departments, and then you 3x. Look at the compounding effect of just that alone.
It's hugely important. Well,
Yeah.
before we get into the rapid fire section, there's one question that I want to ask you, and that is one last question I want to ask you is, how do us as business owners look at creating a system where we're increasing our revenue, we're decreasing our cost, and we're improving our bottom line? How do we approach that systematically?
So this is a case of fully understanding what your growth structure looks like. First of all, increasing your revenue. So what systems you have in place for that to happen? Most important part is, are you going to be able to sustain that extra workload, what you currently have? Because that's another mistake people make, is they're not set up for the extra business. And then they're scrambling because, there's something called economies of scale. So if anything, extra business could end up resulting into lower per unit cost as well. So to be mindful of that, because when you've got that down pat, you're going to reduce your overall cost as well. So there's something called variable costs in every business, where in most businesses, where the more revenue you have, the more that direct cost goes up. So if you're selling one product, you only have cost of one product. If you have two, then it doubles. If you have three, and so on and so forth. So they move in line. So understanding what that direct cost is, understanding your gross profit margin is very key. Understanding, is it to industry average, is also very key, because if you're below average, then you need to know why. Are your vendors charging you too much? You need better terms. What is going on there? So start at the top. Top is your revenue, then is your gross profit, and then is your operational cost, which is kind of fixed in nature, is your rent, your administrative costs, insurance, whatever that is, that doesn't change with your revenue as much. So if you think about those costs are going to be there no matter what, you just need to expand the revenue in a sustainable way that your gross profit margin doesn't get affected. If anything, it gets better. And then these fixed costs are there anyway, automatically your bottom line will get bigger.
I
Right.
love that you're saying that. I had a merchant who owned several restaurants, and he said to me, well, we haven't increased prices in about 8 years. And I looked at him with this stare where he was like, what? Why are you?
Are you serious? 8 years?
I'm like, well, considering inflation was 20% total in the last 8 years, plus or minus, that's insane because I know that your cost of goods has gone up. So have your margins just continued to shrink? And he goes, yeah. So, well, that doesn't make sense. You're not even in line with what's in the marketplace. And
Yeah.
that's hindering you from generating the revenue and the profits to be able to invest in your business to continue to improve and grow. So you hit the nail right on the head with that. And that's incredible advice.
It's very, very important to pay attention to that, that number. I mean, so things do get expensive, and a lot of business owners are afraid to increase their prices because they are afraid of losing business. It's a very common fear, and I see this all the time. And that's the moment when there was a client of mine who provided dental supplies, and she was always working so hard, and she was making decent profit, but compared to the amount of work she was putting, she wasn't. And I was telling her that, your gross profit margin doesn't look very healthy. It's continuously declining. Why don't you raise your prices? And she said, if I do that, then I'll lose business. And then I sat her down and I did the maths. I said, okay. And I'm going to simplify and tell you in a word. I said, if you raise your price from this to this, how much business will you lose? She said, at least 20%. I said, okay, fine. So let's say you've got 10 clients and you're making $1,000 per client. So you're making $10,000. If you're going to raise it by this much, then you lose 20%. You will make more money even after you lose the 20% clients than you're making today. When she saw that on paper, like in numbers, she got the confidence to do that. And she did lose, but her gross profit increased, her bottom line increased. She takes 4 vacations a year. She's so happy when she comes and sees me. Her quality of life has changed for the better. It made me so happy because what we do goes beyond numbers, Jared. It improves the quality of people's lives. It improves the quality of their mind, and it affects their family. And that is where my passion is. That is what drives us to doing what we do. It's not just, hey, give me your numbers, I'm going to file it. It's so much more than that. So much more than that.
Well, this was absolutely incredible. Before we have you tell everyone where they can connect with you, we're going to go through our rapid fire section. Are you ready?
I'm ready. I don't know what that is, but go for it. I'm ready.
Don't worry. Just quick answers to these questions.
Okay.
Coffee or tea?
Tea.
If you had the opportunity to have dinner with anyone this evening, dead or alive, who would it be and why?
Tony Robbins.
Oh, and why?
I just adore him as my mentor.
Beautiful. Is there a book that you could recommend to our audience that had a big influence on you in your business?
I do have several books, but I'll tell you, I admire Keith Cunningham's work, The Road Less Stupid. It's a really good book. It helps business owners avoid dumb mistakes people make all the time and don't even realize it. I read a lot of spiritual books. My favorite is Eckhart Tolle's The Power of Now and Michael Singer's Untethered Soul. So for me, I find it's a very good balance for an inside out. But business owners typically, a lot of Tony Robbins books are great as well. Unshakable is good.
I have every single one of those on my shelf. Power of Now, I think, is downstairs, but I have all of them. Very good books. I have yet not read The Road Less Stupid, though. That is coming. That is on my list of books to get to.
Yeah. I think Keith has written another book. I can't remember the name. It's not coming to my head at the moment. But there are 2 books of his I really, really liked. Yeah. And Jay Abrams' books are good as well. The one that he talks about increasing revenue sales. Jay Abrams is really, really good with really growth of business sales.
Okay, next question. What is the number one thing that business owners are doing that's killing their revenue?
They are coming in their own way. Their limiting beliefs are coming in their own way.
So let's say you are a business owner. You're doing $10 million in annual revenue, and I walk through your front door and I hand you a $300,000 check. How would you suggest that they invest that $300,000 to grow their profits?
So if they're getting $300,000, they have to see what is needed in order for them to get. It depends on the business. So some people will say, I'm going to buy more equipment to improve production. I'm going to hire more people to do that. It depends on business to business. A lot of the times people struggle even at that level of revenue with cash flow. It's surprising that I say this, but they do struggle with cash flow and that. So it will be very easy for the business owner to get sucked into the operations of it. Whereas if they can just step back and say, this is the money I wasn't expecting. Okay, it's come in. What did I always want to do to improvise? If they've got their head in the game to always grow and improvise their bottom line, then they will already know what needs to be done with that money.
Excellent. And my last question for you is, what is the biggest obstacle that you had to overcome in your life to build the success that you have today?
Oh my God, I had so many. Which one do I tell you? It's all of the above, mindset shift that, okay, if I take on more work, if I accept more clients, it's going to mean more work for me. That was a biggest one that a lot of people can relate to. And I'm going to share that. Taking on more work does not have to translate to more work for me. If I've got the systems in place and I've got the team adequately trained and they're following certain standards, it does not have to mean more work for me. And that I'm very, very proud of, that I have overcome that. We're growing beautifully. We're growing organically. A lot of our new clients are referred to us. We're not advertising as such or marketing in any way. That a lot of it's just that we provide such excellent service that people hear of us and they come to us. And we're accepting new work because, at every, like this, I related to, and I also spoke to a client of mine one time. And I said to him, oh, you can easily 2x, blah, 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 whatever. I went through the numbers. And he said, no, I don't think I can cope. And I just looked at him. I'm like, why not? You have a team. He was afraid of the growth. And when he saw how it's possible, within a year or 18 months, he 2x, he did exactly what I told him he could do. Right. And I be able to do that because I did it for myself. Even when it came to pricing, I was so underpriced when I started out, and it was my limiting belief, as it is a lot of my clients. So it allows every pain point that I see my client go through, most likely I've been through it. So I'm able to relate to that. And that is why we have a very good, relation is when you can relate easily to the other person. So you relate to their pain point and you understand what they're going through and you tell them, no, it can be this way because I've been there and I've done it like this.
That's beautiful. Ishali, please tell the audience where they can connect with you if they'd like to do so.
Well, they can definitely reach out to us on our phone number as 905-567-0706. They can also visit our website, www.taxaccountantidm.com. TAXACCOUNTANT. I for India, D for Dad, M for Mom.com.
Beautiful.
So these are the great two ways that they can reach out. On the website, they can just send us an email and we'll be in touch with you.
Beautiful. Ishali, thank you so much for joining us on 0 to 100.
Thank you so much, Jared, for having me. It was a pleasure. And you're right. I really did have fun. I did what I'm most passionate about doing, is helping business owners.
Beautiful. Thank you.
You're so welcome.
Thanks for tuning in to 0 to 100 podcast. We hope you feel inspired and ready to accelerate your business. Remember, your journey to success starts with a single step. Keep learning, keep growing, and keep striving for greatness. For more resources and show notes, visit jaredguyrandolph.com. We'll see you next time.